Okay, we're going to start with the last panel. The effort here is to pull together the thoughts of the day and offer some answers to all the problems that have been raised. And we have a superb panel to do that. We'll start with our co-host for the event, Joan Pisani-Ferry, who has kindly agreed to give a summary of what went on during the day, to recapitulate the main conclusions and results, and that'll help set the tone for the rest of the panel. Mohammed El-Arian will be our next speaker. Mohammed is, of course, co-CEO of PIMCO, the world's largest bond investor, among other things. Mohammed ran the Harvard investment operation prior to returning to PIMCO a few years ago. He spent a number of years at the IMF, and so has a comprehensive understanding of both the market side and the policy side of all this. Unfortunately, Mike Froman, who was scheduled for our panel, got called to a meeting with the president at exactly this time, and so had to back out, and we regret that. I'll sort of share with Mohammed speaking from a U.S. standpoint, and it won't be the same, but we will at least give that geographical perspective. Sharon Bowles is our final speaker and our European policymaker in this final panel. Sharon chairs the Economic and Monetary Affairs Committee of the European Parliament, has done so for 5 years. She has been a veteran vice president of the European Liberal Democrat and Reform Party. She was professionally a patent attorney in earlier years, and we're delighted, Sharon, that you're with us to present the European perspective on all this. So, Joan, start us off, and we'll go then to Mohammed and Sharon, and I'll bring up the rear.
Thank you, Fred. I would like to speak under the control of the two driving forces for this conference, Jakob and Nicolas. But I think the idea and our common idea was that there was a need to redefine the transatlantic economic relationship, precisely as the title indicates, in an era of growing economic multipolarity. The traditional view about the transatlantic relationship is that it is the most important economic relationship in the world. And of course, we know it's wrong. It's not true anymore. And that we can congratulate bilaterally on the size of trade flows, on the fact that maybe trade is not anymore the most important, but FDI is so important, and capital market integration is so important. We basically miss the point. And the point is that the world is changing extremely fast, that this relationship in relative terms is diminishing in importance, and that it needs to be redefined in this new context. And I think that was basically what this conference was about. So I wouldn't use the term reset because it has been taken already, but I think that's really the redefinition is what it is about. Now, we've gone through a number of essentially four type of issues, starting with the macro, then with global climate change, financial regulation, and global financial architecture, which touched upon many things, but in the end was about governance. And on each of them, I think we came to slightly different conclusions. On the macro, I think the conclusion was that we are collectively too weak to fail. That the US and Europe are the weakest part of the global economy in terms of the recovery, in terms of the nature of the challenges they are facing in this recovery phase. And the question we started from is, why are we diverging? We were very convergent in the recession phase in terms of the policy solutions. Very much the atmosphere of the day is that there is divergence. There is divergence on the monetary response. There is divergence on fiscal response. And is it a matter of different situations? Is it a matter of different doctrines? Is it a matter of different institutions? What we discussed is that there can also be different perceptions of the same situation or of similar situation, with a much more Keynesian view prevalent here and a much more structural view prevalent in Europe. that leads to have different views on what is desirable. Then we went on to discuss to what extent in this context we can coordinate, whether coordination is still the name of the game today. In the paper I wrote with Adam Posen, we advocated a relatively modest quantum, but minimal quantum of coordination in this context. Stan Fisher in his comment said, well, it's not about coordinating because you think it's desirable, it's about having a system that provides incentive to behave in a consistent way. And this system is not really in place, so that was really the question we ended with. On the environment, I would say we're too small to fail, really, because we know the EU and the US are going forward a relatively small part of the global emissions, even though they still represent a significant part. At the horizon, which we have to reason, their importance is diminishing fast. And here the question is whether the degree of disagreement there is a different perspective with the EU now thinking about whether they should go for a 30% reduction in emission by 2020 instead of 20%, and the US where the debate is not moving forward, where the legislation is stalled. This contrast was extremely striking, and the question the panel ended with is, in this context, what can we still do together? Is there a scope for some sort of cooperation? Is it on technology? Is it on innovation that we should focus on? Or is it some scope for having a common or a communication between the trading scheme, even though will be extremely difficult if the price of carbon is not the same. So a situation where the degree of divergence in preferences really handicaps the cooperation very much. Now on global financial architecture, I would say the US and Europe are too important to fail. Really, this is a field where we feel the most that we are still the regulators of the world, even though the G20 was enlarged, and rightly so. The driving force of the recent reforms and the reform that we've been discussing and the agenda going forward, because it's not certainly not completed, the driving forces have been the Europeans and the Americans. And I was struck by the lack of any clear division in terms of what is desirable. There were more in the presentations by Nicolas and Maurice Goldstein. It was more the fact that the situation is not the same because the US is a unified market with a single fiscal authority. Whether in Europe we are confronted with the fact that markets are integrating fast, but policy has been lagging behind market integration, and all the momentum is about the catching up of policy integration and legislative integration or regulatory integration with market integration. And therefore, that the notion of what is too big to fail was not the same just because of that. It was really determined by this clear difference of situation, much more than by any difference in vision about the agenda going forward. And finally, on governance, and here I can be very short because most of you were, or almost all of you were here when we talked about it. It's here where we are perhaps too powerful to fail. We're still extremely powerful in those institutions, and the name of the game is how and to what extent and how fast are we going to share power. And the panel ended up with this discussion on the chairs at the IMF. I found the tone cautious for a meeting here at the Institute. I was surprised.
Maybe, stir it up.
Especially Ted was extremely unusually restrained. So I do think that the procrastination that there has been is worrying. That I fear personally that the name of the game now is that the US is requesting a change from the Europeans, rightly so. The Europeans come up with half a change and tell the US we're able to do more, but we expect some move from your side, especially on the bank and the fund, the criteria for nationality, especially on the bank, and that the US is not responding, so that we're going to continue with this type of relatively unproductive discussion. At least that's my fear. So let me end here with perhaps slightly biased, but I hope relatively comprehensive overview of the debate.
Thank you. That's extremely helpful. It'll tee up some questions for later. Mohammed.
Thank you, Fred. Thank you for inviting me. It's a huge honor to be here. I'm going to be reacting in real time to the summary that was just provided by Jean. And I'm going to redefine the question slightly. You said the general agreement is that the relationship needs to be redefined. I will put it differently. I've said that the reality is that the relationship is being redefined, and the question is the how and the what to. So it is currently being redefined, and the question is, where is it going to be, where is it going to end up? If you want to regain control of the situation, if you want to be able to ask the question, how should it be redefined, as opposed to it's going to be redefined and we're going to be receiving at the receiving end, I totally agree with the points you said. We need a quantum of coordination, we need a set of incentives, and we need the ability to course correct. So what is the reality? What is actually going on the ground? So let me give you a very partial view of what's going on the ground. And I would argue that the initial conditions are such that they, rather than be enabling of an orderly redefinition, they are disruptive to an orderly redefinition. So you have to change the initial conditions that are on the ground. The way I think of that is exactly how it's put in the title, which is a redefinition between EU, US, in a redefining global environment, in a multipolar global environment. So those of you who like to think of it, it's about variances and covariances. You have to have a view of how the US and the EU are behaving, and the variances there. And then you have to think of the covariance matrix that somehow has to solve with a lot of other things that are happening that are outside the control of the EU and the US. So it is really a very complex process to solve and to gain control of. What are the major issues? And here, Fred, I'm going to reduce it to one issue for each block, in the hope that simplification of complexity sheds a lot of light. Okay, it may actually be oversimplified, but let me speak to that. And what I'm going to argue is, unless we understand how unpredictable both the variances and the covariances are, we're not going to be able to explain the behavior that's going on right now, where entity after entity in both the US and the EU are self-insuring. They do not believe that the infrastructure will deliver good outcomes. So they are taking actions to self-insure. And that's true for the world as a whole. Think of large company holding massive amounts of cash on their balance sheet. Think of households who are able to de-risk or de-risking. Think of accumulations of reserves. There's a sense of self-insuring going on because people don't trust the system. Here I can't help but react to something you said, Jean. You said, when it comes to governance, when it comes to the IMF, we are too big already to fail. I would say no, you are failing, because increasingly countries are going outside these organizations in order to deal with their issues. So the organization itself is failing for being a place where people go to on that. So what about the variances first? The US issue in our mind comes down to a very simple question. Is there the political and economic ability and willingness to recognize three things? One is that this country is going through a massive structural change after a great age of leverage, and Carmen Reinhardt and Ken Rogoff's book sheds light on what happens after a great age of credit, of debt, and of leverage. So is this country able to deal with these structural changes? Second question, what will be done about the remaining overhangs? We still have overhangs in the system that have to be dealt with, and until they are dealt with, they will undermine a quick recovery. And finally, what do we do with the financial services sector that is in the muddled middle right now? It neither serves the real economy in a manner that is expected, nor has it regained strength. It's in the muddled middle. It's not quite sure where the financial service fits into all this right now. Absent progress on these three things, national agendas will totally dominate the EU-US relationship and will also dominate the multipolar issues. How about Europe? What is the major issue in Europe? Again, simplifying it, it's the question of how long is core Europe defined as essentially Germany and the ECB, how long are they willing to contaminate their balance sheet and underwrite problems of debt, problems of competitiveness, and problems of credibility elsewhere in the Eurozone? That is for me the fundamental question. How long are they willing to underwrite this? Like the US, the hope is what I would call the immaculate recovery, that somehow things recover and the tide comes in and raises all boats and we don't have to worry about these things. The reality is that immaculate recoveries are very difficult to engineer. And therefore, there has to be some view on this, because until that issue is resolved, it will take up a lot of attention on the European side. These two issues speak to the variance. How about the covariance? And here, Fred and I can have a really interesting discussion. I think the major challenge facing the world is how to accommodate a breakout phase in systemically important emerging economies. This is for real, this breakout phase is for real, and it is coming at a time when the global economy is facing other pressures, so it somehow has to accommodate it, and that means accommodate it on the trade side, on the currency side, on the capital flow side, and this accommodation can end up in different ways. In fact, when we try to model the world, we are stunned by what the distribution of potential outcomes looks like. If you think of a distribution that we live with easily, it tends to be bell-shaped. There is a dominant outcome, 85, 90% probability, and there are tails, but they're thin tails. The sort of redefinition that we're talking about globally results in a very different curve in terms of expectations. It results in a much flatter curve. There are many more potential outcomes. There is no big dominant outcome. And the tails are much fatter. So you can tilt. Okay, call it path dependency, call it multiple equilibria, call it whatever you want. But the reality is, it's very hard for anybody to define a regularly shaped bell curve of expectations. Right? And that is why, I go back to the issue, that is why people out there are self-insuring increasingly. Because it's not fooling anybody that we see it. And that is why we hear about currency tensions and we hear everything else. Let me end with the reality that it is the national and global realignments that are going to redefine the relationship and not the other way around. Right? So one has to have a view on the national and the global realignments, and they will be the drivers of the redefinition of the US-EU relationship. This will change if one of the following happens. First, if the EU and if the US can have a common analysis of the issues and a common objective. That does not exist today. Secondly, it can change if you have well-functioning institutions that are credible again. And the previous panel pointed to the difficulties that are being faced right now. And the rest of the world is not waiting for these difficulties to be resolved in a measured way. And thirdly, it has to be done in a way that also accommodates the breakout phases in the other side. Unless you get that, then the question is going to be a relationship, an EU-US relationship that is the outcome of something as opposed to something that is targeted and delivered. So let me stop there.
Okay, Mohammed, thank you. Very thoughtful, very provocative. Sharon.
Right, is this working right? I'm sure that is. Right, well, I'm a complete fraud being here really, because I wasn't here for all of the previous panels, so I'll have to try and improvise and give some responses to some of the things that have been brought up. Quickly referring back to what Jean said, I mean, he said that why are we diverging in the EU and the US, and to some extent that is due to different responses, but and I think as Mohammed has been perhaps getting at to some extent as well, you cannot get away from the fact that we have a single currency area with the Eurozone, and the influence of the sovereign debt crisis that we have had within the Eurozone, and the fact that the euro is not a reserve currency means that we have different drivers and some different problems that we have to cope with, and that's obviously having an impact on some of our decisions. And I suppose if I'm going down then that track, and the provocative question about how long will Germany and the ECB put up with underwriting everybody's debts, I mean, that's a very serious problem for us, that of course we are aiming to address through a set of economic governance measures that will mend some of the lack of coordination in European policies. But of course it's going to be quite a battle to get those through in a sufficiently strong form to probably have powers that bite. And as some people who might have followed what I've said on things, I'm not myself convinced that it's enough, because we have got links through and problems into the sort of micro-prudential and into the regulatory sphere that exacerbate our problems. Again, coming back to a single currency area, and when we have a zero risk weighting on sovereign debt, this ends up providing some odd and perverse incentives at certain times in the cycle. But now is not the time really to try and mend that. But we have to bear that in mind for the future, that there are some things in Basel that actually don't fit when you have a currency union that cannot print its own currency. I think, looking at the other point that Mohammed said about the self-insurance, whether that be firms or individuals, I'm not sure it's only a lack of trust. I think this is to some extent an uncertainty, that there has been so much talk about everything having to be changed and redefined, and the instincts both domestically and for businesses are therefore to pull in their horns and to not spend things and to save money, which of course is exactly what we don't want at the moment, for those that could actually be spending and could actually be stimulating the economy. But human nature is what it is, and I don't suppose we're going to be able to change that overnight. But I think that some of the language that we use, and some of it was in the last session as well, pointing out that there's a disappointment in the slowness of implementation of the change in regulation. Well, why is there disappointment? You know, it's 2 years of the financial crisis. We had a slight problem in both Europe and the US in that we were changing the Commission in the EU, so we had to wait for the new Commission to get in. You had the slight matter of having to elect Obama, so you had to wait until you had your new administration. And these things did mean that there was a certain amount of not getting our acts together as quick as we might have done otherwise. But early in the crisis, in the European Parliament, we had our panel of wise men, Baron Lamfalussy and others, who said, well, what we don't want is a knee-jerk reaction. And within about 3 months of that pronouncement that everybody thought was a good idea, what are we doing? We're trying to come out with an enormous tsunami of legislation that worried industry without us having the details. And then subsequently G20 put on the table the comprehensive roadmap, as we now call it. But why are we being disappointed that it's taking a little while to operate? If you take OTCs, I was just making a little list here. So G20 said, well, it'd be a good idea to get derivatives onto exchanges, or at least to electronic platforms. But they didn't tell us whether there was going to be central bank liquidity or commercial liquidity. They didn't tell us what was going to be the role of competition, or the governance, or the ownership, or the interoperability, what the capital requirements would be, how the margining was going to be done, who or what was going to be the participants or the users, what are you going to do with the different needs of the different asset classes, and that commodities and physicals are very different from financials, and actually how do you measure robustness, and how do you build the tools for interpreting or interrogating all the data that you're going to put into these data repositories, so that you just haven't expensively collected things, and are you going to look at things in real time or aren't you? And what about the rules relating to access, where Europe's got a lot of concerns about data protection, and we're not very good either between the EU and the US sometimes, with the US giving the right access to the EU. We've got lots of problems in things like audit still. So it's all very well to say, well, G20 mapped it out, but we're the legislators. We have to deal with a whole range of these things, and that's just a short list. And on derivatives, we're actually doing quite well in the global context, probably because we do realise this is one area that could move very quickly. But one way or another, it is coming together. If you look at something like credit rating agencies, the US started off first with its legislation, and then the industry came and tried to bully Europe to do the same, but we did something slightly different, and the US has taken some of ours. And this sort of nudge process is ongoing and improving the legislation. Industry does tend to try and push us to the first to move, right, that's got to be it, now will you please do the same? But I think we've actually shown that we're not playing that game of it's a competition of, first to put something down, and that's the marker and that's it. One way or another, we are intelligently joining up. And so I look at this as a glass half full story rather than a glass half empty story, at least as far as the legislation goes. There's some bits that aren't great, I admit, but we seem to be getting better at it as we go along. I think what does strike me, though, is then, if I stick with derivatives because there's been so much activity on it, coming across my desk, I have countless charts of comparisons of what the EU is doing and what the US is doing. And I agree that covers most of the markets. But it would be nice sometimes to have one that was a comparison of what was going on in Japan and elsewhere. And because they have been doing things, it does actually join up again sort of reasonably well. And I think for us to just focus, because we are the majority of the market, and to say we're not looking at what's being done elsewhere, or if we go over to banking, we're saying we're not taking notice of what is going on in Asia, we're losing a big opportunity to build trust, because there is a distinct lack of trust. Yet when it comes down to it, we're now trying to be cleverer and to use some of the macro prudential tools, and that they've actually used quite well in Asia. So we are ignoring them, but then actually going to perhaps bring in some of the things that they have been doing. So we should have been joining up past. And I think now is a great opportunity. That the moment is still not gone, when we should be aiming to build trust rather than to be looking at everything fearfully. I mean, something that I've said in the context in Europe when we were doing the new supervisory architecture, and we talked about colleges of supervisors as the global organisation, and of course we want colleges to be a real supervisory force. But what was actually said, in the secrecy and the privacy of trialogues especially, the only points that were ever raised were about confidentiality. It wasn't how do you make the College of Supervisors into a decent force. It's how do you stop the wrong people getting the wrong information, which I thought was really rather a sad way to proceed. I've got a few other little things here that I've been thinking about. We are talking a lot about having more bodies of the Basel type, of the FSB type. I mean, you can put in the International Accounting Standards Board, and they can come up with technical decisions, but you've still got a problem with a democratic link. And so we then enact the legislation that comes from it. Sometimes we can do it automatically, but we have to admit that it isn't always done. We don't know whether or not the United States will do Basel. We hear the promises, but we heard those for Basel II, and it's impossible to imagine that they can do Basel III if they don't sign up to IFRS. I mean, if we don't solve the International Accounting Standards problem and IFRS, we can forget about there being an EU-US agreement that everybody is doing Basel III. So we better sort that one out somehow. And I know that there are problems on both sides here. There are disagreements over how things should be done. But nobody's actually sort of pointing the finger at that, I don't think, strongly enough. I think we've got an interesting time ahead if we look at where we're going with some of our rulemaking and the interaction between corporate governance and supervision. And that's going to be an interesting area looking forward, where there may well be divergence between the views of what we want to impose between the EU and the US and other countries. I'm concerned that at the same time as we concentrate all our effort on things like leverage and liquidity, that we're fast moving down a track of unintended consequences. Are we actually removing moral hazard, or are we creating more? What is the sort of concentration of thinking about liquidity measures doing? Is any equity ever going to get a look in anywhere if we start transferring the kind of prudential regulations that we're talking about in Basel over to insurance? that happily used to have 20% of equities, now only 5%, and it will get worse. So how are we actually going to get any investment into the real economy if the only thing that you're going to be able to hold is sovereign debts and derivatives? Where's the long-term investment going to come from? And what does this do to the lack of diversity? When we come to crisis management, I think that's a very interesting area where ultimately we could recognise good crisis management in capital requirements if you get the cleavage planes and the escape modules and all these things to work together. But what happens if you make a mistake and you take a bank in to restructure it when it wasn't really in trouble? I'm not quite sure who pays for that. And I think if we're going to start looking at insurance for as a sort of systemic financial institution, and everybody always waggles the finger about AIG there, but I mean, it was a banking mistake, it wasn't an insurance mistake. I mean, I'm quite worried about this, that we're going to try and treat insurance the same as banking. But we're not looking at systemic groupings. We've already got an example of this in Europe with the Casas in Spain. They're all separate little banks, but they were all exposed to the same kinds of problems. So you can have quite small banks that can be systemically relevant. If they've all got the same business model and something happens in the economy, they'll all go the same way, and you could find yourself, at least within a country, in as much of a mess as if you had a big bank going down. So I mean, I think that we haven't put enough thought into that. And many of the things that we're doing now, we should be honest about, that certainly as regards capital, they were all in there in Basel II, in Pillar 2, but nobody did them. There were things in there that said if a supervisor doesn't understand complex financial products, then how about having a bit more capital? So, I mean, the net result going forward has to be that I think things must be simpler. I mean, I know that this is straying a little bit from the relationship that you're talking about, but there may become a divergence of opinion over simplicity. But if you go back to the global outlook and the multipolar, the one thing that has been different in Asia is that they kept with simplicity. One thing that is still a point of contention in Basel is that in the US, actually you do want some simplistic backstop measures on leverage, whereas in Europe they seem to not be quite so keen on those. So I think we still got quite a big debate to have in and around simplicity, and that in itself can be part of the shape of the future of the EU and the US relationship.
Thank you much. Jean started this last panel by suggesting that the U.S.-Europe relationship was no longer the most important in the world, and that may be right, but it's still pretty important. And so I'll just take a very few minutes here at the end to suggest where I think we stand on the 3 or 4 issues that I mentioned way back at the start this morning, I thought were the key ones that the transatlantic relationship now faced. First, and Sharon's just been discussing that, financial regulatory reform. Sharon suggests that there still are a number of important differences between the U.S. and Europe. Mario Draghi, to the contrary, asserted that, at least for the moment, things seem to be pretty well agreed. The Basel Accords to be ratified by the G20 summit in Seoul, and that probably is the realistic outlook. I must say some of the outside government observers, Ted and Gary in their paper here, Morris Goldstein, Simon Johnson in their work here at the Institute, all concur that the outcome was disappointing, but it does seem that the officials are burying their disagreements for the moment, go ahead with this first step, which everybody agrees is a good first step. And so I suspect that issue is under control for the moment and will not produce any big conflicts. The second area was the exit strategies and effort to walk that narrow line between continuing the growth recovery and avoiding debt buildups by starting a consolidation process. There are really two issues under that heading, I think, in the transatlantic context. One is what some view as a premature German fiscal tightening, and the second is what some view as inadequate expansionary measures by the European Central Bank. Germany has not been pushed by the bond vigilantes, to the contrary, but Marco Beauty contended this morning that its fiscal tightening is small, not front-loaded, so not very serious to worry about. To which the response would be, that's probably right, but the sign is wrong, and at least for the next year or two, policies of that type by the chief growth engine in Europe is going to condemn Europe itself to slow growth, could even push it to a double dip. That's certainly the leading risk of such a turndown in the world. And that in turn spills over into weakening in the world economy. So I suspect some disagreement is going to continue on that. The monetary issues, of course, are not really discussed in the G20 and intergovernmental forums because central banks are, of course, sacredly independent. So governments don't dare talk about that, like in summits in Seoul. But as somebody commented this morning, it's almost axiomatic that the ECB is going to have to ease interest rates, pursue QE a la the Fed, particularly if it goes more, the Bank of Japan, if only because the exchange rate is going to pinch increasingly. Nouriel Roubini focused on that. And so in the meanwhile, there will be some costs in terms of lost growth, possible risk of a double digit, the exchange rates fluctuating even more so and perhaps getting out of alignment in the direction of euro overvaluation. So I think that too will continue to be, to some extent, an issue of disagreement. Third area, IMF reform, does strike me as more confrontational. We had a very polite, as Jean said, abnormally polite discussion here between Jörg Asmussen and my colleague Ted, even though I tried to incite him. He resisted for once. But that doesn't resolve the fact that there is real confrontation on this issue. And it's a three-way confrontation. Secretary Geithner, of course, has now, for the first time, explicitly linked U.S. agreement to an increased role in the fund for China to China's cooperation on the currency issue. He said that very clearly Wednesday in his speech, and it's, I think, part now of the U.S. position. That comes on top, of course, of the U.S.-EU difference over who's to be overrepresented, who's underrepresented, how to change not so much the shares, but the chairs on the executive board and all the technical details about the size of the board going forward. But that issue, I think, has been brought really to the brink of confrontation, if not already to it, by the U.S. veto of the continued 24-seat board. And so within the next few weeks or month, that one, I think, is probably headed toward a real dust-up. There's a package deal to be made. The U.S. is going to have to make some concessions. It has not yet indicated a willingness to concede, though my guess is it will do so. And so it can certainly be resolved, but not yet. And that one may have some bumps, at least in the short run. Finally, and I think probably the most serious, is whether the U.S. and Europe can get together vis-a-vis the rest of the world, and particularly China, on the issues that have come up repeatedly today. The U.S., including the Congress, clearly wants a multilateral approach to the problem, wants to effectively use the IMF, maybe the WTO, certainly the G20, to bring a resolution within the agreed rebalancing context. But to do that, there clearly has to be a coalition of the willing to be willing to put some heat on the Chinese. I leave open the tactics privately, publicly, but to really bring to bear the weight of the weight of a substantial majority of world opinion, certainly starting with and led by the US and Europe together. Yet, when the IMF discussed the China problem in the fairly innocuous forum of the IMF Executive Board just a couple of weeks ago, only a couple of Europeans agreed with the US to take even a modestly tough rhetorical line with China on the nature of the problem, let alone push for a solution. When the Chinese lean on everybody around the world not to even let the adjustment issue be discussed at the Seoul summit, I'm not sure how Europe is going to come out, not to mention the emerging markets who tend to side with them, even when their other officials are denouncing the impact on exchange rates and real economic effects. This is all very important, because if the multilateral effort fails, the Congress is going to act. And the U.S. will take what the world will view as unilateral action, on the grounds that if the preferred anointed institutions can't do it, somebody's got to do it. You can't just let it go on forever. And so I think this is a real testing ground for US-EU cooperation, and then hopefully radiating out to a broader multilateral grouping. And if we can't even get together on that one, which is so clear in terms of its substance, and where the impact is now spilling over to the entire world economy, if there are currency cum trade wars, it clearly runs off that massive imbalance. Yes, the U.S. obviously has responsibilities for it, but nobody wants the U.S. to tighten the budget this month or this year, surplus countries least of all. And so we've got to have some give, particularly from the country, the biggest economy, the biggest surplus, the biggest reserves, the fastest growth rate. If we can't get together to bring that imbalance into some semblance of progress, our relationship, I think, is pretty frayed and pretty tattered. So there's the usual wide agenda. The degree of difference on them, I think, differs. The degree of importance of the issues differs. And even if Joan's right that it's not anymore the most important relationship in the world, I think all these issues indicate that it's quite important, and we better be able to get our acts together, at least better than we are now. Okay, back to my hat as chairman. We've reached the witching hour. Unfortunately, no time for discussion, so I'm going to bring the day to a conclusion. I want to do so by particularly thanking Jean and Bruegel for being our partners in the exercise, thanking the European Commission for sponsoring and supporting and enabling the whole thing to happen, particularly, and he hasn't gotten mentioned much today, thanking Jacob Kirkegaard, along with Nicolas Veron, who organized the whole operation. Jacob was doing it here day to day, and I want to thank him particularly for making all this possible. I also want to invite all of you to stay on, go back out in the patio, have another refreshment before you leave, continue the discussion informally, but thank you all for coming. Thanks particularly to this final panel. Joan, Mohammed, Sharon, thank you all very much. Meeting adjourned.